Now to the economy and your money in a tough transition here. The Federal Reserve has issued a new interest rate hike, raising its benchmark rate 0.5%. This is now the 7th interest hike of the year. So how does the Federal Reserve decide whether or not to raise rates, and who in the organization is making that choice? Here to break it all down is ABC's Elizabeth Schulze in our segment, Bring on the Econ.
The Federal Reserve, aka the Fed, is one of the most important institutions in the global economy today. Chances are you've heard the Fed is raising interest rates to try to cool off red-hot inflation. It's one of the central bank's two main tasks: keeping inflation in check and keeping the jobs market healthy. Let's start with how the Fed controls inflation. Basically, the Fed makes the cost of borrowing money more expensive so that consumers like you and me think twice before we take out a loan and spend our dollars. When fewer dollars are floating around in the economy, prices and inflation should go down. So how exactly does the Fed raise interest rates in the first place, and who are the people there calling the shots? To understand the answer, we have to go back to the early 1900s. After a series of bank runs and financial panics, the Federal Reserve Act was passed by Congress in 1913. It established the central bank as an institution that operates independently from Congress or the White House. The Fed doesn't report to any other agency. It's pretty much its own boss, but it does give regular reports on the status of the economy to Congress. Leaders of the Fed aren't elected by the public. They're handpicked by the president and approved by the Senate. Fed chairs are typically not politicians, but economists who've spent their careers at banks, universities, or government agencies. And their terms don't coincide with elections. So a Fed chair appointed by a Republican president could still be in charge, even if a Democrat is in the White House. The current Fed chair, Jerome Powell, was appointed by former President Trump in 2018.
He's strong, he's committed, he's smart.
And reappointed by President Biden this year.
I'm nominating Jerome Powell for a second term as chair of the Federal Reserve.
Every term lasts 4 years. 8 times a year, the Fed chair and leaders of regional Fed banks from across the country meet to vote on whether to raise, lower, or keep interest rates the same, changing how expensive it is for you or me to borrow money. That brings us to the Fed's second task, keeping unemployment low. At the same time that the Fed wants to tame inflation, it also wants to make sure that everyone in the economy who wants a job is able to get one. If the Fed raises interest rates too high or too fast, costs can become too expensive for businesses, forcing them to lay off workers. High interest rates hurt consumers, too. Think of it this way. When interest rates rise from 3% to 6%, the payment on a $300,000 fixed 30-year mortgage goes up by more than $500 every month. When the Fed votes to hike rates, it's not actually raising the rate on your mortgage. Instead, it's charging banks more money to borrow from the government. Banks then charge consumers more money to cover their added costs. So a Fed rate hike ripples across the economy, all the way down to your wallet.
Hi everyone, George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel, and don't forget to download the ABC News app for breaking news alerts. Thanks for watching.